Australians spend around $50 to $60 billion every year offshore, so a big portion of that money is now coming domestically, and a big beneficiary has been the automotive sectors.
The key for us is understanding the customer value proposition. So the companies that we invest in have very strong value propositions where it is proven that the customer really needs their products.
Analyst projections were very negative for these companies and really forecasting a doomsday scenario. But as it's turned out, Australia's done a fantastic job to stop COVID effectively, and with borders reopening, we do see a very strong period for these companies.
More recently though, we've started to invest back into housing on the back of our view that the historically low interest rates, the strong government fiscal support, and over time, lenders will relax lending criteria is going to drive housing activity.
What's been lost on the market is the cash flow these companies are generating right now is at record levels. So there's going to be a lot of cash on these balance sheets with minimal debt. So we do see the potential for earnings accretive acquisitions going forward, which we think will be the next leg for growth in this sector.
When we caught up in May, you outlined a bullish view, which turns out to have been a solid call. What's your view now if we do that sort of looking forward? Are you bullish, bearish? How would you answer that same question as we sit here in November?
I was chatting to my parents this week, and they were blowing up about how you can get a fixed term interest rate for 5 years, less than 2% these days, and they would have loved to have that back in 1991 when interest rates were close to 20%. So I think with that backdrop, it's hard not to be bullish on the market, and particularly when we've seen the extreme measures by central banks and governments globally to support economies coming out of COVID. And we've also seen a relatively positive outcome to the US election, and we've also seen a potential vaccine. So we think we're very positive on the markets going forward. And I think within that context, we're very positive on small caps. And I think it went back in May, I think I was probably more positive on large caps. I actually see one of the best environments for small caps we've seen in some time. And this largely reflects the fact that around 40% of the stocks that we look at in the small cap market are exposed to the economy in some way. So I'm talking about sectors like retail, building materials, automotive. So we do see a very strong period for small cap companies going forward.
If we just stay on that, so as we sit here, you really feel like there's confidence in this reopening process now, and that's really the opportunity for you to find opportunities going forward?
I would say, look, if we split it up into two, so if we go back into when we last spoke in May, we would have talked about sectors like retail, domestic tourism, housing that we were positioning the portfolio into, and a lot of these companies were exposed to Australia. And if you can go back in time and think about May, Australia was in a much better place than the rest of the world. And as it's turned out, we're in November, we've done an incredible job at managing COVID. So a lot of those trades have played out, and we have reduced our weightings to those sectors. But where we see some value at the moment is looking at those companies that have significant international operations in COVID impacted regions such as Europe and the United States, where analysts have been forecasting a very negative scenario for these companies over the next 2 or 3 years. And we do see a number of companies, and I could rattle off a number of names like United Malt, which is one of the largest malt processors globally, Ramsay Healthcare, one of the largest private hospital operators, and also we've been adding positions in some of our existing names like skincare manufacturer BWX, and also Infomedia, which is a technology company.
Yeah, it's quite a different set of companies to what we talked about in May, and one of the themes that we did touch on in depth in May was around agriculture. Is that still a theme that you think presents an opportunity?
Yeah, we think it's a great theme, and I think what's driven our bullishness on that sector is the fact that the crop has just gotten, or the rain that we've seen on the East Coast has just gotten better and better. And in fact, if you look at the recent crop forecast from ABARE, which is the government body that forecasts the size of the crop, it was actually 24.3 million tonnes in September, and that's actually the largest forecast that we've seen in the last decade. Now, the recent rain we've seen over the last few months means that we think this crop forecast will get upgraded again. Now, what you generally see after periods of long drought is that when you have a big crop or a lot of rain like we've seen in the La Nina period, it'll extend for a number of years. So we're still very positive on the sector. We've got our two biggest holdings would be Elders and GrainCorp. Elders will benefit as more farmers buy crop protection products. GrainCorp is the most leveraged to an increase in the crop size. We also think that a number of the efficiency gains and cost savings implemented by management over the last few years will come through in the numbers. But we do also see a number of other companies that will benefit over the medium term. One company that's under the radar a little bit is Select Harvest, which is one of the largest almond processors in Australia, and they've been impacted by COVID and a lack of demand for almonds in regions such as India and China. If we have a vaccine, we see some more support in the almond price. We see significant upside to the share price in Select Harvest.
The ag sector, it is so cyclical. You sort of outlined a bit of a bull thesis there. What are some of the things that you look out for? What can derail the thesis there?
Well, it's a fascinating one. I just went to Byron Bay in Yamba. Really like Yamba, by the way. It's a great spot. But and I was looking at the weather, quite a lot going into it, and all I saw was thunderstorms. And maybe that's just a part of my personality. I probably shouldn't do that. I was really annoying my family, but anyway. But it's clearly the weather, and particularly for something like GrainCorp, which, we were on the verge of harvesting what was a record crop, and we've seen the onset of hailstorms. It was a big risk, and we actually sold some GrainCorp going into it because the hailstorms forecasts were actually going to be quite large. Now, as it turned out, it wasn't as bad as what perhaps we had thought. We actually bought back in a week or so later. So definitely the weather is the biggest impact for these ag stocks. But as I said, it's a record crop. It generally will have a good few years after this. So we're very positive on the sector.
We can't talk about small caps without talking about the high-flying technology names, and they're not so small anymore. A number of these WAC stocks are moving up into the top couple of hundred. What's your view on technology, and if you can talk specifically around valuations, and then I guess how do you get exposure to technology in a sensible way?
So the WACS companies are the tech leaders on the ASX. The challenge for us is that often these companies are always fairly valued. So as a team, we spend more of our time trying to identify the undervalued growth companies that could be the future tech leaders. So there are two themes that we like. The first theme is around the disruption to traditional retail by the e-commerce companies, which we have spoken extensively about over the last 12 months. The recent share price appreciation and the volatility has garnered a lot of interest. However, we continue to be strong believers in the e-commerce names because we believe the structural shift is here to stay. Now, the key for us is to be very selective. Companies like Temple & Webster and Adore Beauty, we believe, are exhibiting very strong unit economics and strong customer loyalty. And so as a result, we believe they're very well positioned to continue to grow in the future. For example, both of these companies were growing at more than 50% in a pre-COVID lockdown environment. And that's a signal to us that these companies can continue to generate those strong revenue growth in the future.
Yeah. We're sitting at a point where, the prospect of travel is becoming more real than it has been in the past. We've had news about, a vaccine and people are talking about the prospect of even heading offshore. We're going to see, I suspect, some more movement domestically as well. What's the opportunity in tourism? Is it a local opportunity? Is it a global opportunity?
We think it's a mixture of both. If we start off with domestic tourism, I think I talked about this back in May, probably thought we were all mad to be investing with those companies at that point in time. But I guess when you're looking forward, analyst projections were very negative for these companies and really forecasting a doomsday scenario. But as it's turned out, Australia's done a fantastic job to stop COVID effectively. And with borders reopening, we do see a very strong period for these companies. So companies such as Sealink, which is the largest bus and ferry operator in Australia, Ingenia, which is provider of manufactured homes and tourist parks, and also Tourism Holdings, which is the largest rental company of motorhomes in New Zealand, Australia, and the United States. I think actually a really interesting anecdote was around June, ourselves and WAM Global caught up with Thor and Winnebago, which is the largest manufacturers of camper vans effectively in the world. And at the time they were flying. They couldn't get enough stock on the ground. Effectively pricing was going up, and they said to us, look, this is a very similar scenario environment that we saw back at September 11, back in 2001, where you saw a period of 2 or 3 years where people didn't want to fly and they wanted to drive. And so if you look back at Winnebago and Thor, their revenue growth over that period of time was very, very strong. And that was a big catalyst for us really to invest in a number of those companies that were exposed to driving. And hence why we're positive on domestic tourism.
Okay, and what about globally? I've got a trip to the Maldives to go surfing has been put on hold indefinitely, and I'm itching to go surfing. That's not an opportunity for me at the moment. Are you thinking about playing offshore players?
Yeah, so we also invested in Flight Centre and corporate travel management. I mean, the initial thesis was that these companies and their cost out management programs were going better than expected, which gives them ample liquidity to navigate the next 24 months from a COVID environment perspective. More recently, the potential vaccine has potentially pulled forward the revenue profile, so we continue to be bullish these companies.
So you've really looked at how those companies have got themselves in good shape and taken, sort of looked out a bit further.
100%.
Well, I think the interesting thing was when we went to the August reporting season, there was a number of companies that had done well in various sectors, but there was one sector that had not done well, and that was international tourism, effectively. So I think Webjet, corporate travel, Flight Centre, and the short interests were building in those companies, and we did a lot of extensive work around their balance sheets, and we thought at the time they were fine, and they could really get through this period, and that was the time when we invested in those companies. As Tobais said, they've done quite well for us. So we've now seen the next leg, which is a potential vaccine, and what that means is that when people are forecasting the earnings for these companies, they might have been saying, well, we think in 5 years' time, it's going to be similar to what it was in 2019. Well, maybe it's not 5 years' time now, maybe it's 4 years' time, and that's what's brought it forward. So that's why we quite like that sector.
You mentioned a road trip, and it's been a really big theme, this domestic travel. You hear stories about people not being able to get access to new cars, the Toyota Prados are out of stock, all this sort of business, and it was something that we talked about. Auto's been strong. Is it still an opportunity, or has that something that's rolled over now?
Yeah, auto's been a fascinating sector for us. We really did position the portfolio in a number of names back in May, and I think when I had this interview last time, we talked about the fact that we saw the potential for increased driving or kilometres driven, just as people prefer to drive a car instead of use public transport when they go to work, and also to drive a car when they go on a holiday instead of use a plane or a cruise. Now, while that's partly driven the auto sector, I actually think what's been more important is the fact we can't travel overseas. And Australians spend around $50 to $60 billion every year offshore. So a big portion of that money is now coming domestically, and a big beneficiary has been the automotive sector. So companies such as Bapcor, Super Retail, GD Holdings, AP Eagers, Motorcycle Holdings, they've done very well for us. And we actually saw very strong updates over October, and we did take the liberty to reduce our positions in these companies. Now, in saying that, we are actually very positive on this sector still. And I think what's been lost on the market is the cash flow these companies are generating right now is at record levels. So there's going to be a lot of cash on these balance sheets with minimal debt. So we do see the potential for earnings accretive acquisitions going forward, which we think will be the next leg for growth in this sector.
So sort of, if you were to I know we've talked about a few of the things that you do like, but if I could get you to kind of summarise what you think some of the compelling opportunities that are in the fund right now, like how you give people a sense of how you position for the next period.
So housing is definitely one of them. I think this time last year we talked about our positive outlook on housing. Unfortunately, due to the COVID market volatility, we had to significantly reduce our housing exposure in the last financial year. More recently though, we've started to invest back into housing on the back of our view that the historically low interest rates, the strong government fiscal support, and over time, lenders will relax lending criteria is going to drive housing activity. So companies we like include Brickworks, which is a brick manufacturer in Australia and the US, and AFG, which owns the largest network of mortgage brokers.
Yeah.
I think childcare is an interesting industry as well. I mean, you could have gotten a more impacted industry through COVID. It's a very important industry for the government in particular to get people back working. So we think the government will support the industry, but probably more importantly is this industry for the last 5 or 6 years has been really impacted by an increase in supply of childcare centres. We don't expect to be seeing that over the next few years. So we do think the incumbent operators, which is G8 Education, which is the largest in Australia, and also Evolve Education, which is the largest in New Zealand, are poised to benefit.
What are some of the things that you think are not grabbing headline attention that might be getting overlooked?
Yeah, I think over the last 10 years, we've seen companies exposed to the housing market underperform the ASX by about 50%. We think this will turn around in the next few years, and this is due to record low interest rates, fiscal support for the industry, as we think Australia will basically have a housing boom over the next 2 to 3 years.
If you got a message for shareholders, opportunity, we didn't get to get face-to-face with them again in November. What message would you leave them about the opportunity in WAM Capital and WAM Micro at the moment?
Yeah, I mean, it's a great opportunity to thank everyone for their support. I mean, it has been a very difficult time. It's nice to be back in the office and seeing everyone. I think yesterday I had my first meeting with an analyst from a stockbroker since January. So it's great to be going back to normality. Team's doing very, very well. That's just the wider team with the guys in WAM Leaders and WAM Global. So all of the shareholders have been very supportive, and fingers crossed we can catch up with you all in May in 2021.
Great. Well, thank you both for taking the time to sit down and talk us through how you're putting their money to work.
Thank you.